Hi there, this is Mike Larson, Editor-in-Chief of The Money Show, and I'm coming to you from the Orlando Money Show 2022. I'm here with Catherine Avery, the CIO of Avery Investment Management. She's also the sub-advisor to the EMPWR Sustainable Dividend Equity ETF. Catherine, thanks for coming.
Thank you, Mike.
Okay, now that's a mouthful. I think I got it out properly. So let's talk a little bit about the Dividend Equity ETF. What is the investment style? What is it that you're looking at to help investors do via this vehicle?
Well, we are one of the few actively managed ETFs that not only focuses on dividends, but dividends that grow.
Okay.
And at the same time, we have an ESG integration into the portfolio as well. So basically, we want companies who can pay an above average dividend yield, grow it at above average rates, and at the same time, have a good moral compass.
Got it. So is it a combination of a systematic approach plus, again, I'm just kind of curious as to the methodology. Like, how do you pick the companies that are in there?
We start with a screening process.
Okay.
It's our own proprietary screening process. Starts with the S&P 500, where we screen for names that have a dividend yield equal to or greater than the overall market.
Okay.
And then from there, we do more fundamental research. We want companies who have strong balance sheets, low levels of debt, and that's where we're able to figure out which companies can grow that dividend and sustain what they already have.
Okay.
And on top of that, that whole ESG integration is just as important as well. We want to make sure that companies are focused on doing the right thing for their clients, because when companies don't do the right thing for their clients, we wind up with what we call headline risk.
Yeah.
Headline risk is not exactly good for companies.
No, not in this environment.
Because when the companies start to be in the news, it could be a negative for the stock price. So those companies that are already ahead of the game.
Got it. Okay. What types of companies are you finding are screening well in this environment? I mean, it's obviously we know it's been a tough market, but the dividend focus has to help, right?
Right. The dividend focus definitely helps, but it's also very important that in a rising interest rate environment, you focus on low PE companies.
Got it, okay.
So this is a market where you really want to focus on companies and buying companies and not buying the overall market.
Okay.
So again, that active management really does play an important part. Because we were able to distinguish between those companies that were trading at attractive valuations trading at 20 to 30% discount to that of the S&P 500.
Okay. Now, when it comes to holdings, I mean, how broad of an ETF are we talking about? Your typical holding list is what?
Right. We own 30 to 35 holdings, and they're equally weighted.
Equally weighted, okay.
Because it's our belief that all our companies are great. It's just a matter of time for when the market actually realizes that full value. But we're also able to underweight and overweight sectors in the portfolio.
Okay.
So for example, this year, we've been overweight energy and we've been overweight healthcare.
Oh, that's two great sectors to be in, especially in this environment. So if that's your overweights, what have you found that you've tended to be underweight in this environment?
Consumer staples.
Yep.
And utilities.
Okay, which is interesting. I mean, a lot of people have sort of, will say they hide in the utilities, they look for that yield, but what is your methodology? What is it that avoids utilities?
Again, it's the valuations.
Valuation, okay.
Right, so especially more for the consumer staples. Consumer staples are trading at about 20 to 30% premiums to the S&P 500, and there's no growth there.
Yeah.
So, you can get sort of a decent dividend yield, but there's no room to really grow it. So what happens when that whole trade starts to unwind? Then you're left with a company that really doesn't have a lot of growth potential to it.
Got it.
And utilities is the same kind of thing. You have a decent dividend yield, but the growth is really not there.
Yeah. Anything, if you had to put on your sort of crystal ball or your hat about the future, is there anything that you see coming in this market that investors should be aware of? When you talk to people at the show, what is it that you're kind of telling them about this market environment?
Listening from this morning's talks, it was great to hear a lot of people are a little bit worried about next year in terms of being a stagflation environment, and I can definitely see that happening. So it's going to be another tough year again next year for investors, and they really should think about active management, continue to focus on dividends, and especially quality. Because anybody can go buy a dividend ETF, right? But you want to make sure that the quality's there. Quality management, quality balance sheets, quality products and services. Those are the types of companies that are able to pass on the inflation to their consumers or whoever's buying their products.
Yeah, I think that's great advice in this market. I mean, again, the safety, the quality factor in dividends clearly has been working. So.
And have that dividend growing at rates higher than that of inflation.
Absolutely. Okay, well, thank you so much for joining us here at The Money Show, Catherine.
Thank you so
much.
Catherine
Avery. This is Mike Larson with The Money Show. Take care.
Thank you.